10 IRS income tax audit triggers. In this video, I'm going to cover the top 10 IRS audit triggers that you can avoid when you file your tax return so you can reduce your chances of getting audited drastically. I know going through IRS audit is the biggest hassle, and you want to do anything and everything possible to avoid getting an audit from IRS. So in this video, we will be covering those top 10 strategies that you can use so you can get the chances of getting audited reduced drastically. My name is Jayanti Ganapati. I'm the owner of Finaccurate. We are an accounting firm based in Boston, Massachusetts. We will be covering more income tax related videos in our YouTube channel. If you want to learn more and learn about the tax saving strategies, especially for small business owners, please subscribe to our YouTube channel and also click on the bell icon so you will get notified when we release more YouTube videos in the future. So let's get to the 10 IRS audit triggers. Number one, you did not report all of your income. So this happens a lot when you have a side hustle. You have a small business and you are doing multiple jobs as a contractor and you're receiving 1099 from those jobs. And if you did not report all of the 1099s that you received, it could be for the small work that you did, it could be interest from an investment account or interest from a bank account. It could be many reasons you receive a 1099 from. So if you don't report those income in your tax return, what happens is those organizations who you provide the service, they are required by IRS to file the 1099 form with IRS, and they already have the income reported to IRS. And if it doesn't match from when you file your tax return, and if you did not declare those income, then there is a immediate mismatch, and that can automatically trigger an audit of your income tax return. So you want to make sure number one, you received all of the 1099 and you reported those 1099 income in your tax return. And even in the situations where you did not receive it, or you received it late, you received after you filed your income tax return, you are still required to report those income in your income tax return. So any mismatch on a 1099 can result in a very easy audit trigger for you. So avoiding that you can avoid a lot of hassle in getting an audit trigger. So most of the cases, this can even result in at least a audit letter coming from IRS requesting for more documentation and information why you missed to report that income. So you want to avoid that. Number two, you're taking a home office deduction. Again, this happens a lot when you have a small business and you are working from home and you are claiming a home office deduction. This is a legitimate tax deduction, but this is also one of the deduction that is abused by most of the small business owners. Like they're claiming more expenses on the home office. But the home office deduction, you have to make sure you are using a space which is dedicated to do the work. This is not your space in the kitchen or kitchen area or your living room that you are also claiming as a home office. Though you may be doing work from there, but when you claim home office deduction, this has to be a dedicated home office space that you are not conducting any other work there other than your business related work. So make sure you are claiming the correct home office deduction. Anything that's over-reported, anything which is over the norm can be an easy audit trigger. So you want to make sure you're avoiding that. And now number three is claiming 100% business use of your personal vehicle. Most of the small business owners obviously are using one the vehicle for both business and personal. And if you seem to have reported 100% of your business vehicle as a business expense, which is your gas and insurance and any other car repair or any other cost related to the vehicle, if you claim 100% of this, the chances of getting audited is also very high, because there's always a chance you are smallest percentage for your business. Most of the cases, it's 50-50. You use your vehicle 50% for business, 50% for personal, or income. In some cases, you are using it 75-25, but the chances of using a vehicle 100% for business is very low. So IRS has a trigger for anyone who is reporting 100% reduction on their business vehicle. So you want to make sure, if you are really using 100% for your business, yes, go ahead and claim it. But if you're using for both business and personal, you want to make sure you are calculating the correct percentage of the business use and claiming only those expenses in your tax return. Number 4, you had unusually large business expenses. Most of us as small business owners, we will be reporting travel and meal as a deduction in your income tax return. So this is a very common deduction that you take, but this is also one place where the businesses tend to take more deductions on, and the IRS has a audit trigger on this. IRS has a expenses by industry. They have a limit of how much each industry can be spending on travel and meals. So they have a norm by each industry. Anytime you are seen to have reported more than 20% of the norm set by IRS, then that can be an immediate trigger for an audit. So you want to make sure you are not reporting over and above how much your industry would normally spend on travel and meals expenses. So this is something you want to avoid. Again, once there is an audit, this is also one deduction that you have to produce, collect a lot of documents to prove all the travel and meal expenses are legitimate. Make sure you are avoiding this. Also part of this is mixing your business and personal expenses. Again, it happens a lot in these two categories, travel and meals. You might have traveled but also taken out a personal vacation. So you want to make sure you are allocating the business and personal days correctly, and then you are allocating the expenses correctly between business and personal. Same happens with meals. You are going out for lunch, but you can only claim lunch if you are having a meeting with a vendor or a customer. It has to be a business lunch. Only then you can take a deduction. But if you are just taking lunch for yourself, then that can be a personal. So you want to make sure you are very clear in not mixing your business and personal expenses when it comes to travel and meals. So you can avoid the audit trigger. Number 5, you had large charitable contribution reported in your tax return. We know charitable contribution is an itemized deduction on your tax return, and with the exception of this year and a few more years going forward due to COVID, you could take about the line up to $300 in charitable deduction. But then on your itemized deduction, if you are seen to have taken a large amount of charitable deduction, let's say you are claiming 50% of your income as a charitable contribution, or 50% or more, like 60%, 70%, then that's not something normal. Though it can happen, but that's not something normal for anyone to contribute 50% or more of the earned income or as a donation. So if you're reporting higher charitable contribution, if it's legitimate, make sure you have sufficient document to back up that. If it's not, then make sure you are not crossing the limits, and have a check on your income tax return before you file it, so you can avoid this trigger. Number 6, you reported several years of business losses. Most of the small business owners are, it does not naturally happen. You are having many years of continuous loss in your business. But if you're reporting losses year on year, like 5 years, 6 years or more, then that can also be a trigger for IRS thinking that you are claiming more expenses than the money you're generating in business. So that can also result in an easy audit, and then you will have to prove all of the expenses you claimed on your income tax return which resulted in a loss, and you'll have to prove that is all legitimate. Number 7, audit rates by income category. In this, here I'm going to cover the probability of getting audited by IRS based on income category. Do you know that there are 150 million tax returns filed throughout the United States, and IRS is not going to audit all of the tax returns. And they're also going by, when they audit, they want to go after whoever is reported larger income. So when they audit it, they are collecting more money. Last year, IRS collected $50 billion through their audit process. So they're all obviously going with the logic, and here is what I can share with you based on income category. So if you reported negative income losses in your tax return, the chances of getting audited is 5 to 12%. That is actually the top probability of getting audited. And if you're reporting negative income or losses in your tax return, the probability is really, really high. It's 5 to 12%. If you're reporting income under 500,000, that's the lowest probability of getting audited. It's less than 1%. If you're reporting income 500 to 1 million, the chances of getting audited is 1% and slightly above 1%. If your income is 1 million to 5 million, it is 2%. If your income reported on the income tax return is 5 to 10 million, it's 4%. And 10 million and above, the chances of getting audited is 8%. So as the income goes up, the probability of getting audited goes high. And the opposite one is if you're continuously reporting losses in your tax return, then the probability of getting audited goes high as well, which is the 5 to 12%. So yeah, make sure you are avoiding this. Point number 8, you have made errors in your tax return. So the errors can be principal errors, like you entered your social security number wrong, you entered your home address information wrong, or you did not enter your dependent information, or it could be arithmetical errors. This can happen when you're paper filing your tax returns, and you entered, let's say, instead of entering $10,000 as income, and you entered $1,000 in income. You didn't mean to do that, but you just didn't notice it. And there's like errors in adding up the totals and the reporting the totals or subtotals. So if you're using a tax software, this will be avoided. I know still the majority of the population still are paper filing. So if you're paper filing, this can still happen. So make sure that you are avoiding these errors. So because that way you are avoiding the automatic audit triggers as well. And point number 9 is engaging in cash transactions. There are a lot of small businesses who collect cash, and whenever there is a cash transactions, you are required to keep proper documentation of the cash collected and how it's remitted to the bank, and keep a proper reconciliation, and also make sure you are reporting the cash receipts in your income tax return. So whenever there is a cash transaction and you're heavily receiving cash in your business, that can also be an automatic trigger. So even if there is a trigger and if there is an audit, you want to be sure you are prepared to face the audit by way of showing proper documents for cash collected, reconciliations, and remitted to the bank. Once you have that, then you can be pretty sure you will come out successfully on the audit. Point number 10. Breaking the rules on foreign account. Every individual must report foreign assets worth at least $50,000 in a form called 8938. So if you're not reporting that, it's in the informational form. If you're not reporting that, what happens is the overseas banks are required by IRS to report any American asset holder who has a bank account with them. They are required to report to IRS that bank holder's information. So IRS is already receiving that information from your foreign bank, and if they see that you are not reporting the foreign account in your income tax return, automatically creates a mismatch and automatically triggers an audit. Again, this is something you want to avoid. If you have at least 50,000 in net assets in an overseas bank account or in an investment account, you want to make sure you are reporting that in your tax return as well. So as long as you take care of these 10 items, when you file your tax returns, the probability of getting audited gets reduced drastically. I cannot say you can completely avoid the audit. What we covered in this video is the top 10 items. As long as you make sure these are taken care of in your income tax return, you can be sure like the probability goes down drastically, and you don't have to be overly worried about being audited. Thanks for watching this video. I hope this was really helpful to you, so you can avoid the tax audits in your income tax return. We will be producing more videos which are tax saving focused for small business owners. How you can, what are some of the strategies to save taxes. So be sure to watch our videos. Please subscribe to my YouTube channel by clicking on the subscription button below, and also make sure to click on the bell icon so you get notified when we produce more videos in the future. Thank you. Thanks for watching my video.